Hey, good evening. Thank you all for making time in your very busy schedules to join us on tonight's webinar. It's so good to be back. Tonight's a really special event. We are going to be looking at the 2023 DSO M&A markets, kind of how we got to where we are, and as importantly, where are we going? We're having these conversations. There's no one better to have with me than Brian Kaleo. Brian of Dykema, it is so good to talk with you again. How you been?
I've been doing well, Kevin. It's been too long since we've done this. I mean, we usually do these, fairly regularly, but I know we've everybody's been busy with crazy things going on. Had an incredible summer with our event, so we've not done this in a while. So I'm real excited to be with you here tonight doing this.
Yeah, I feel like time's gone slowly, strangely. I saw you in July at the incredible Definitive DSO Summit, and since then, it's been there's been a lot of work going on, a lot of deal flow, a lot of activity, a lot of noise in the market, a lot of changes, and that's really what I want to spend some time talking with you about. Your group does more transactional work in the dental space than any group in the nation. So, and I know you can't name client names, and I know you have to uh, respect the confidentiality of your clients, but general trends are really what I want to speak to as you and your team see more than anybody. So you're really, well suited to talk about what's going on in the kind of upper echelons of the dental M&A marketplace.
Yeah, what I've been telling everybody as I speak at various events across the country and the last really all year, really after the first quarter is it's been sort of tricky out there. I mean, I think the first quarter of the year I told everybody it's a little tricky. It's a little bit of a difficult environment. We're going to watch it closely. Now that we're sort of drawing to the end of the third quarter, I can tell you it's slower. I mean, it was explosive in 18 and 19, and even the back half of 20 after everything opened up, and all of 21 was completely explosive. There were good reasons. People were expecting tax rate hikes on capital gains, and everybody wanted their deal closed by the end of the year. So, that was kind of crazy. But, beginning sort of back half of last year and carrying over into this year, it is, it's decidedly slower. I would say slow but steady. There is a lot of demand and a decent amount of inventory, but the explosive part I think is taking a pause, and I think it's slow, steady, and deliberate deal flow is what we're dealing with right now. And there's a lot of reasons for it. I'll stop there and say slow, steady, deliberate deal flow. I know you and I will discuss all the reasons for it, but that's where it is right now.
Yeah, it's going to be interesting because I know we have two unique viewpoints on what's going on based on our experience. So for those of you watching at home, you've got a little bit of a preview of what's to come. I'll tick through the agenda briefly and then remind everyone that you can always lob in questions. So we in the chat, if you want to lob in your questions, Brian and I will do our best to sift through those and answer questions we find most relevant, assuming we have time at the end of this. But we're just going to hit on the high points right out of the gate here. I certainly want to go back and revisit what happened in Denver at the Dykema Definitive Conference. Didn't want to get a recap on that. So those who were not lucky enough to be there with us, Brian, can relive it through the story you'll tell. And then an update on where we are in the M&A markets, and then dialing a little more closely focused on the specialty side. This has been one of the fastest consolidating segments of dentistry. It continues to trade at remarkable multiples. We've seen some good exits in recent, let's call it, years for those who jumped in the pool early, built really nice platforms and exited. And we've got more specialty DSOs than ever right now. So y'all know me, I'm President of TUSK. Brian, director over at Dykema. For those of you who don't know us, come out to Denver next year and get to spend some time with us. But Dykema is absolutely the definitive source for all legal needs when it comes to the DSO world. We've been lucky enough to work with them, and our clients primarily work with them when Dykema's not conflicted on the other side. So, Brian, get us current on what happened out in Denver this past year in July.
Yeah, we had our 10-year anniversary this year. It was terrific. We had just about 2,000 people there. Depending on how you calculate it, we may have had a little more than 2,000, but just about 2,000 people there, record sponsorship, just an incredible event. You know, our goal with the conference, and it's exceeded even my wildest dreams from when we had 41 at the very first event, was to have, you know, the best content, best networking, most fun. And I really feel like we did that. We had incredible content. Part of that content, of course, was the TUSK sell-side workshop, which happened on Wednesday before the conference. I thought that was terrific. I had the privilege of opening that up. We had sold out. I mean, I think you guys limit it to 100, and it just gets sold out so quickly of people that are interested in either selling, exploring, selling, wondering about the market. That's an incredible event. I think you've committed to coming back in 24, so I'm excited about that. The regular event, you know, we had, you know, Belinda Carlisle from the Go-Go's gave a concert, private concert. We had Andre Agassi there. Just a lot of really incredible content. All the sessions were packed with, you know, like I said, nearly, you know, whatever the ballroom holds. We had over 2,000 at the whole thing, but the ballroom was packed throughout. The weather was beautiful in Denver. So, you know, incredible event. And if you haven't been, we really want you to come check it out. We're going to have it again in Denver at 2024 at the Gaylord Rocky Mountain Resort. It's July 10th through the 12th. And I think all indications are we're going to have even more people there than we had this year.
Like you, Brian, I go to a lot of conferences each and every year, and this is one where you don't want to miss the opening, right? So a lot of times you're like busy networking or having breakfast, but this is an opening you want to see. It's been a while since I've been to a wrestling event, but I haven't seen more pyrotechnics at an opening of a DSO event than or any real event since I was following Hulk Hogan around civic centers in Montgomery, Alabama. It was pretty spectacular.
Well, listen, we got to get to like serious stuff. People want to hear substantive stuff, but let me just say this for 10 seconds before we move on. My entire dream was like to pretend like I was some type of rock star and explode pyrotechnics and come out on stage. And as it turns out, I am the director of Dykema, and this is my conference. So I just made that happen. We exploded pyrotechnics. It was probably one of the highlights of my life, coming out to 2,000 people and shooting off, you know, sparks and fog and everything. And it was a blast. And I don't know what I'm going to do next year, but if you like pyrotechnics, there's going to be more pyrotechnics next year. But past that, I think people listening want to get to something serious, but I hope everybody can come in 2024.
Yeah, we'll be there. Look forward to seeing everyone there as well. All right, so let's start at the very, very top here, Brian. We get asked all the time, where are we right now in the consolidation of the industry? And we think about it in really three buckets. Like there's private practice, let's call that one location. And we got the mid-market, 2 to 25 locations. This is normally like doctor-founded groups, bank-funded. Maybe there's a little bit of private equity capital in this, but these are probably too small at this point to be funded by private equity. And then there are large.
Yeah, some of them are funded by mom and pop investors, because remember, you know, you can have a one-office DSO if a non-dentist wants to get involved, and I'll get Wharton School grads that call me all the time and they want to start with one office and they get friends and family money. So yeah, I don't know that there's any PE there, but there are some private investors even within the 70 to 75% one location part of the market.
Yeah, that's fair. That's fair. I would call that the exception, not the rule, though. They're just starting out. Many of these, though, are doctors that have been at it for 30, 40 years and that are looking to exit somewhere down the line, and are probably ready to hang up the handpiece. So the single location, the multi-location, then these elite groups, the big groups we see at your conference, typically buyers of our groups that we take to market. But the net of it is it's somewhere between 70 to 75% consolidated today. Would you agree roughly with those estimates?
Well, I think you meant 30% consolidated.
Sorry, 30% consolidated. You're right. Sorry about that.
And yeah, I thought that's what you meant, but so that there's no misunderstanding to people listening, I think Kevin and I are in agreement. You know, is it 29 or is it 31? I don't know, but roughly 30% consolidation right now of the market. The wild card in all this that we keep talking about, or I keep talking about, is 60% of the people don't go to the dentist at all. So the 40% of the known universe is 30% 40% consolidated. That 60% is yet to be tapped into. So these numbers, can fluctuate. So when we come back here next year and we're like, yeah, it's 30% of the market or 31, and somebody calls up and says, hey, you guys for the last 3 years have been saying 30%. How can you keep saying that? Well, the reason we can keep saying that, if you pay attention, is 60% of the universe doesn't go to the dentist. And as we tap into that 60%, the market in effect grows. So there might be consolidation, but because the market keeps expanding and growing, because 60% don't go to the dentist, these numbers don't grow. Like the 30% number doesn't grow as fast as you might think. That would be the one thing I would add to that, Kevin.
It's really good. So the population is growing, and the pie is staying approximately the same, because the number of group practices can continue to grow as long as the population of patients continue to grow.
Correct.
Great. So look, can we slice this a layer thinner? Can we think about that 30% of practices that are consolidated? And can you give me your view on GP versus specialty? Is GP much more consolidated than the specialty space? What's that breakdown look like from your vantage point?
Yeah, I mean, GP is, and we're really working, and I hope in the next year or two we'll have some, ironclad statistics here. It's very difficult because all of this stuff is privately held. There's no, if there were publicly traded companies, we could sort all this out in about 6 months. We'd have great data, but they're all privately held. Sometimes you gotta poll them, and some people don't want to divulge information. So it's somewhat challenging to get this. We're working on it. But the GP practices have historically, just by pure numbers, consolidated greater than specialty. But specialty has been on a tear over the last, 5 years. What I would say is GP got a huge head start on specialty. If the consolidation has been going on about 10 or 11 years, the first 5 years was all GP and nothing else. So they got a big head start. The last 5 years, specialty has been on an absolute tear and is, it's catching up a little bit, but just because GP had such a big head start, GP is clearly more consolidated than specialty, but specialty has been on a tear and is consolidating, at least right now, maybe at a little higher pace than GP.
Yeah, I was at an ortho conference this past week and was talking to the largest aggregator and buyer of ortho practices nationwide. Talking to the head of business development, and he shared with me he believes the ortho space is about 15% consolidated, and of what's remaining, there's about 50% of it only that they want to potentially partner with. So he sees a lot of opportunity out there. But it was interesting how he separated the market between the ones he does want to affiliate with and the ones he does not. And we've talked about this a ton. It's linked to geography, revenue, and upside. And
I know, obviously, we're not going to name names, but I know who you're talking about, and they're somewhat selective in who they're looking at and their algorithm. I would say this, the 50% that he's not interested in, somebody else will be interested in 35% of it. It could be that 15% of it on the fringes is, not particularly sales worthy to anybody, but that at least there's 35% that I think plenty of other people would be interested in.
Yeah, there are new ortho-specific DSOs calling our office on a regular basis, and some of those Wharton grads calling our office, right? Saying, "Look, I want to get in. I need to get in. How do I get in?" So there's a buyer for everyone on the GP side. So long as you're about call it about 1.5 million of revenue, and on the specialty side about 1.3 million of revenue, there's absolutely a DSO that wants to partner with you. Shifting gears here to look at M&A activity, you referenced this already, speaking to why 2021 was such a banner year for those of us in the M&A space. Do you want to call back to that and share with everyone your perspective on the trends that you see here from the data that we pulled from PitchBook?
Yeah, it wasn't a very pleasant year. I think, it was a record revenue. I think, people in my group, it's funny, you'll look back at it, and people in my group made more money that year than they ever have in their careers, and they'll just tell you how unhappy they were with the year because there were just too many deals. There was just unreasonable pressure because everybody knew that we were gonna have a new president, and they knew for 21 the tax rates were safe, but they were fairly certain that they were going to go up in 2022, and everybody was panicked about it because what they floated at one point, if I remember this correctly, I mean, it never came to fruition, but these things were going to go up to, whatever they are now, 15-20% capital gains, were going to go up to like 39%. I mean, it was absurd. They were going to more than double, and that would have a devastating impact on the markets, but everybody knew they could get it out of the way in 21. So everybody wanted their deal closed that year. And, deals were emerging in September and October and November that wanted to be closed by the end of the year. And I have never, in the 20 and now going on 29 years I've been doing this, seen the market at capacity, but the market actually hit capacity. We're like, if you called TUSK up in November, they might say, hey, we can close your deal in 22, but we just can't get it done in 21. If you called my group up and said, we got a great deal, we're going to pay you all these fees, can you close it? And you called me in November, we would have told you, we just can't get the deal done. The quality of earnings people, if you said, hey, I need a quick Q of E done, and you called them in November, they said, we can't do it. The people that do the regulatory reviews and chart audits, if you called them in November, they said they just can't do it. I have never seen the market like that, Kevin, literally at capacity. And that's what happened in 2021.
Yeah, it felt like deals, doctors who were thinking about selling to practices or groups and that were like, I'll sell in 2022 or 2023, said, okay, look, there's a ticking clock here that could really increase my tax burden at closing. So rather than wait another 12 or 24 months, I'll go ahead and get my deal done now. So I think that explains what we saw in 2021 and 2022, right? So that's kind of the return to the norm in 22. And then year-to-date 2023, there have been a lot of headwinds. I mean, there have been increased interest rates. There have been there's the great resignation of the team, and we've had to replace them with higher wages and a lower knowledge about the business of dentistry. The cost of capital is as high as it has been in recent history. And we know that the buy side at the higher echelons of M&A, let's call it the really smart private equity groups, where one private equity-backed DSO is attempting to sell to another larger private equity group, they're getting a little more stingy with their money, Brian. And I think that they're being a little more careful and calculated in which investments they want to make. And you really see that materializing here in this graph for 2023. Volumes are down relative to 2022 and absolutely 2021.
Yeah, I mean, look, the legs came out of the big deals. It's funny, I had a deal right when it was kind of happening. I had a deal close right around the first week of June last year. And I remember it was a very sizable deal, like a $400 million deal. And the bank right around, we started working on that deal, say in March, and we're going to close in 90 days. So we were always going to close around May or June. And in March, the bank was gun-ho. I mean, if you remember, the whole Ukraine invasion and everything started right around, February, March, after the Olympics and everything else. But the bank was gun-ho about it. They were like, yep, you're totally approved for your financing and we're going, and everybody was excited. By the time May came around, the bank was trying to do everything they could to get out of doing the deal, almost making up phony reasons not to do the deal. We literally had to threaten the bank, under their contract, and the bank's words to us proved to be absolutely, what's the word, prophetic, like a prophecy, or, they said, we will do this deal because we're under contract and we committed it, but don't bring us another deal for the rest of the year. And that $400 million deal, Kevin, as it turned out, closed around the first week of June, and we didn't get another deal that size the rest of the year. I mean, we did a lot of smaller and mid-sized deals, and we're actually fairly busy, but we didn't get another deal that size for the rest of the year. I had a $1 billion transaction canceled. I had a $90 million transaction canceled. I had a $250 million deal canceled, all in the back half of last year. And, that was the legs came out of the big deals.
Yeah.
And the smaller deals, you and I even maybe talked about this last year at a yearly recap, that the smaller deals were hanging in there just fine, even though the big deals were struggling. And I think that was the case through about the first quarter of this year, maybe even a little further, maybe even like April or May or something. And then you and I had a conversation right before our conference in July, maybe 3 weeks before. We were talking mid to late June, and we were noticing, both you and I, that, hey, even the smaller deals are now starting to feel this a little bit. And
Well,
that's kind of where we are now.
when we were talking about those bigger deals, not making it being put on pause, not being able to find a buyer that was willing to get a deal done, either due to capital constraints from the debt capital markets or offers that didn't meet investors' returns, that I really looked at that as a canary in the coal mine. I said, okay, when is this going to begin to impact our deals that are $20 million of EBITDA, kind of in that, let's call it $500,000 to $20 million of EBITDA range. And it put me on high alert. And I was like, when is the other shoe going to fall? Because we had this huge pipeline, we had a robust buy side with deep pockets, and we were still getting deals closed. So I ran some numbers for our presentation to show you, for our conversation today, to show you kind of how things worked on our end. In 2021, great year, but the average exit multiple is around 7.5 times. In 2022, although we did less volume, remarkably, the exit multiple went up. And now, year to date, August of 2023, the multiple is north of 8 times on average for all the deals we've closed. And we're going to end this year with the highest number of transactions we've ever closed. That is not in the face of, that is in the face of some adversity. I will say that the buyers have tended to shift around more this year than they did last year. We've always seen buyers that kind of have the hot hand, that are in acquisition mode and are willing to pay up for great assets. But this year we've seen buyers kind of come and go, right? They have a limited available capital. They're going to make a great run at a really great asset. They're going to go ahead and secure that opportunity, then integrate that business. And we might not see them bid on something for another 6 months, or might not put as lucrative of offers on the table. So we're seeing the buy side really shape shift in front of us, and who wins a deal this month might not be in a position to win a deal next month. But thankfully, as we've alluded to already, there are new buyers coming into the market still with capital they need to put to work. So that has
there's
led
a lot
to
of capital on the sidelines and a lot of demand to buy stuff. But the headwinds that we have, unfortunately, are the cost of labor is the highest it's ever been, or in a very long time. The interest rates are the highest it's ever been in a long time. And the result of those two, inflation is high, so the cost of goods is up. So the EBITDA numbers are down, and that's not a time, the EBITDA numbers are down because they're paying more for the cost of labor, paying more for supplies and goods. The buying power of the buyers is significantly down because some DSOs, not all, but some, have seen their debt service triple. They had really cheap money locked in at a variable rate that was almost zero, and then it tripled almost overnight last year. And they all of a sudden had to pay millions of more dollars that would go to profit margin or go into growth and expansion, is now eaten up by debt service. So it's very, very tricky right now with these headwinds. But there still is a lot of demand to do deals, and there are a lot of, relatively speaking, relative to the rest of the economy, a lot of transactions getting done. They really are, because think of it like this, right? If you're a dentist and you've run your practice for 25 or 30 years and you were real smart with your money, you might be about 60 years old or 50 something years old right now, Kevin, and you're financially secure. You've saved your money for 30 years. You're now planning for your house in Scottsdale to be on the golf course. And wouldn't it have been great if you could get, and I think you still are getting some of these, but I'll just say hypothetically, wouldn't it be great if you could get an 8 multiple like everybody got in 2021? But in the end of the day, if you get a 7 or a 6.5, you're financially secure already. This is good money to basically go pay for your Scottsdale house on the golf course. So it's not the end of the world if you don't get absolute top dollar. There are tons and tons of people like that. So there's a lot of transactions still being done. but it's not everybody just piling on, because I think there are some segment of the market, younger folks, others with a bigger time horizon, that really want to maximize every penny out of it. And, unfortunately, this is not the year to squeeze every last penny out of it.
Yeah, there are a lot of forces at work, especially in the baby boomer segment of the U.S. economy. Those individuals have worked hard, had a great career. If they save correctly, they are primed to retire and have earned a great retirement. 5-10 years ago, depending on which market you were in, you were going to get 70% of collections for your business. So even at a 6x, 7x, you're still going to get 150 to 250% of collections. So I'm glad you brought that up, right? It's so much better today, even if there is a little bit of margin deterioration, it's so much better than it was 7 to 10 years ago.
No, these are once in a generation returns still, right? They were once in a generation returns on steroids in 2021, but in 2023, maybe they're not on steroids anymore, but they're still once in a generation returns. If you go back 25 years, people are realizing more return on their investment for their practice than they ever have in a 25, 30. I mean, it would be funny if you drew a graph from 30 years ago to present, that graph would go straight up like a rocket ship, and then between 2022 to 23 would slightly go down, but it's still so much higher than it was over the last 25 years that this is still a very lucrative thing to do.
So broadly speaking, Brian, if we're in a sideways market with respect to multiples, or let's say we're slowing down and actually heading down from peak valuations, how quickly, what does the other side of that graph look like? Is it a steep line down? Is it going to be a plateau? Are we going to see a stair step? What do you envision seeing? Because I've got my opinion, but I want to hear yours.
I think it's a plateau mostly. I mean, this is what I would say, Kevin, and I know we talked a little bit offline about, some things that we might talk about today. And maybe this is the time, I don't know, this is not a political show. I'm not here to be political about things, but all things equal, I think for the time being, I would say the rest of this president's term, I think you're going to be sort of like a sideways plateau type situation. I don't think the multiples are going to explode upward. I don't think they're going to go down. I think for the rest of this presidential administration, they're going to be sort of where they are now. Then it gets kind of interesting, right? You got this uncertainty, right? I looked again, this not being a political show, but just stating just some neutral facts. This particular president doesn't have a high approval rating. Even his own party seems to think they don't want him to come back, but he is nevertheless running for re-election. So that's kind of a problem. You look on the other side, who's running against him. That particular candidate has a lot of support, but a lot of legal problems and a lot of issues. So we don't know, like, are the legal problems going to overcome that particular candidate and he's not going to be able to get elected? Or is he going to get around those legal problems and somehow get elected? Or is he going to get around those legal problems and, lose because, the fact that the legal problems and all that issue exist, just enough people aren't going to vote for him. And then we're going to be back to this president for another 4 years. Or are we going to have a brand new candidate somehow step up and, have that person? So there's all this uncertainty. And I think how that shakes out will determine the other end of this graph. So that's why I say for the rest of this presidential administration, we have certainty. We know who's in there. I think you're going to see sort of like a plateau, but then depending on what happens, if for example, if it's 4 more years of this president, I don't think that's going to be positive. I think the graph could even go down, and I don't think that's going to be terrific. If it's one of the Republican candidates, pretty much anyone, a new one, or the incumbent that everybody knows about, I think it'll be favorable. I mean, I'm not here to talk about policies and what it means for the overall country, but I am here to talk about the dental M&A markets. I think it'll be favorable for the dental M&A markets.
Yeah, this conversation around risk and how Wall Street looks at it, and we keep in mind, like, Wall Street drives interest rates and interest rates drive valuation. That's really the connective tissue here of why it's all important. If we don't have a clear front runner as we get closer and closer to election date, and look, that could be that as our current president continues to take the stage, I think people lose confidence in him as maybe the front runner on the Republican side faces the legal issues. If we're unclear on who is even going to run, that's going to lead to instability. And as soon as we have some clarity on who might win through polling, I do believe we will begin to see credit markets open up. A part of it is just not knowing who is even going to be running at this point.
Yeah, but I think that's absolutely right. There is so much uncertainty right now. You have a sliver of uncertainty with the Ukraine war, which I think affected things a lot in March of last year. It's not really affecting that much the M&A markets now, but you have a little bit of uncertainty with that. You have a lot of uncertainty as to who the Republican candidate's going to be. The front runner's got all these legal problems. There's other people. You got to work through that process. Then once you figure out who the front runner is, you got to figure out who's likely to win between that person and the existing president that's running against. And I think that'll be very telling. I think if for some reason, our existing president comes back for another 4 years, I don't see that being terrific for the markets. So far that led to inflation, this year, cost of goods and some unpredictable things. And I don't think that'll be a tremendous development for the market. I do think if any Republican candidate ends up getting reelected, whether it's the front runner or another one, I think that will be more favorable to the M&A markets for dental. Again, not making a political statement on what that means for the rest of society or America, but as it pertains to these dental M&A markets, I think it will be favorable.
Yeah, so I agree with you on where multiples are going. Back to the graph scenario we're talking about. It does feel like we could be on the back end. We are certainly on the back end evaluation for the plus businesses that are over $20 million of EBITDA. That time has come and gone, no doubt about it. And it's feeling like we're plateauing out there. What might have been a 14 or 15x, even higher than that, now feels a little bit more like a 12. Is kind of what we're hearing from the upper echelons of the market. Does that feel about right to you, Brian?
Yeah, with certain outliers. There was a specialty oral surgery platform that went for a 16 near the end last year. It was one of the exceptions to the rules where I said all these transactions were canceled and none of them went through. Well, there was a certain oral surgery one that did go through, I believe, in November and got like a 16. So, I think there will be outliers. If you are the premium in the market, you are the best oral surgery, you're the best endodontics, even GP, you're the greatest GP thing we've ever seen. People might pay a premium for this reason. There's two valuations. There's the objective criteria as to value, and then there's what a buyer and a seller in an arm's length transaction will pay. And what you see for the premium assets is a bidding war. You see like, hey, this thing should go for a 10 or 11, but these three parties keep just bidding against themselves and have to have it. So it ends up going for a 14 or a 15. You will still see that for certain select premium assets. But I think on average, I think, the norm is going to be 11s and 12s and 10s and things like that.
Yeah, so it's absolutely outliers are out there. There's a deal that traded 19 times way back when that everybody's aware of. But the meat of the mean of the exit multiples, it feels like that 12x is kind of becoming the new norm for the large enterprise level $20+ million EBITDA businesses. So if they're going to be trading at 12, the thought is the arbitrage is getting compressed. So how, what should happen to the rest of the market? Where do you see, let's call it the middle market, traditionally pre-private equity? Maybe there's some individual investors and wealthy investors in this space, but how's that going to impact the $500,000 to $20 million EBITDA businesses?
Well, like we said, we joked about it. I know you're aware of this. That's a huge.
It's gigantic. Yeah, it's big enough to drive a truck through. I'm just trying to illustrate here the group practice world.
Yeah, I think it'll impact it less on the smaller deals because, quite frankly, if you pay a little higher multiple, and everybody listening, sort of knows this, right? If you've got $500,000 of EBITDA, and you decide to pay a 5 multiple, that's $2.5 million. If you decide to pay a 6 multiple, that's $3 million. If you pay a 6.5 multiple, that might be several, I don't know, several $100,000 more dollars, but not the end of the world. You're playing with smaller monopoly money down at that level. So if I like your little solo practice and you have a $500,000 of EBITDA, I can throw an extra 2 or 3. I mean, jacking up the multiple results in an extra couple $100,000, and people have the budget for that. So
Not
I
as
think,
big of a
they can get competitive on those smaller deals because jacking up the multiple equals a few 100,000 extra, and that's not a big deal. When you get to 20 million or 19 million or something, and you start throwing every point, the difference between a 6 and a 7 is 19 or 20 million dollars. A 6 and an 8 could be 40 million dollars, and I think people are going to have to be a lot more stingy on the upper ends of that, and they're not going to bid nearly as aggressively. But at the smaller levels, even $1 million in EBITDA or $1.5 million, you can afford to go up and bid a little bit, because you're talking about, the difference between hundreds of thousands at 500K or $1 million in EBITDA or $1.5 million EBITDA. You might be talking about an extra million here or there or something. That's really not going to bust anybody's budget if they have to have an asset or something. And they can even, do several of them like that. But when you get up to the higher end of that 20 million, yeah, it's going to be really tough to get to those higher multiples. That's what I'm afraid.
Yeah, when I think about this bucket, it's I think the more logical way to look at it is, let's separate it when you get up to kind of, let's call it $3 million of EBITDA to 10, and that's where private equity groups are more than happy to make an initial investment inside of a group, right? And at that point, you have a larger buyer base, and their expectations are, yeah, we might have to reach on this one, but we believe we can buy down that multiple over time. So although the larger established DSOs, strategic buyers in this case, might not be able to stretch, a new buyer certainly can. And that's what's so interesting about this space is new buyers come into market all the time with different investment theses that see a great 5-star asset and say, this is the one I want to reach for. And so I certainly believe there will be excellent businesses that decide to run a process will still get double-digit multiples in this, call it $3 to $10 million EBITDA range all day long. They certainly will.
Just because Kevin, it's like maybe not everybody that is listening follows the NFL draft, but if you follow the NFL draft and the collective bargaining agreement, if you go in the top 10, you get a premium under your contract, as if even among, if you go 15, 20, and those that don't know, there's 32 teams in the first round, so there's 32 picks, and under the collective bargaining agreement, if you go in the top 10 of the first round, they pay a premium. You are entitled to a premium on your contract than if you go 25, 26, 27. And it's the same thing here. If you are the cream of the crop of your category, we look at this year of everything that's 3 million in EBITDA that's going, everything that's 1 million, everything that's 5 million in EBITDA, and you are the very best in class. Yeah, it wouldn't surprise me if somebody breaks the bank and does a 12 or a 13 or a 14 on a one-off because they want the number 1 draft pick. They want the best in class in 3 million of EBITDA in the market. But if you're just a run-of-the-mill 3 million in EBITDA or an average one, yeah, you're going to be stuck with these lower multiples.
Yeah, and again, it's lower multiples for a period of time to be determined what happens in the future, driven by all the uncertainty that we just spoke about, and we talked a little bit about this a moment ago. Presidential elections, what's going on in the Ukraine, the strikes we have here, the oil prices. Looking at GDP as a percentage, public debt as a percentage of GDP, all this noise out there, it impacts it as well. But the primary driver right now, I think, is interest rates. And the cost of capital has gone up sizably. I was on the phone with
tripled. I mean, some of the folks you might have had, a 2 or 3%, now you're 7%. I mean, it's just, I can't emphasize enough, Kevin. I know we covered this earlier, but your debt service, I'm just hypothetically, if you're a bigger organization, your debt service might have been $2 million, and you may have had 6 million of profit after that, and now suddenly your debt service is $6 million. I mean, think about what that does to your profit and your EBITDA.
Well, and I think people sometimes get a little. I think this is an area of confusion because we know in the definition of EBITDA we're adding back interest expense, right? So we know that the interest is added back when we calculate EBITDA. So why does it matter? We get asked sometimes because it matters because those dollars actually leave the account and they impact cash flow, and that cash flow is king when you're growing and building a business to pay your bills, to pay your team, to continue to keep cash in the bank so the lenders will keep lending you money. This is the big problem. And
Yeah,
if
I
interest
mean, it's
rates are
very
going,
simple to think about. The accounting can get complicated. We're not here to give a, some type of seminar on gap accounting or accrual versus cash, but it's just simple, right? I have organizations right now that I represent whose debt service before this whole mess might have been hypothetically $2 million, a year or whatever, and now it's $6 million. It's tripled. It's literally $6 million a year. And in other years, they use the delta between the 2 and the 6, that $4 million as profits, and they could maybe do some other deals, use it for cap investments, use it for other things, and now it goes to debt service, and that's made things very, very tight.
yeah, that instance you just referenced is unique to that individual business, and not everyone has the same cost of capital. Not everyone has the same capital stack. It's interesting, Brian. We're seeing so many more announcements right now of DSOs who are announcing that they've raised capital. Not that they've even done a deal, that they got a new credit facility.
Yeah, well, you know what that is? Let's just
Yeah.
call a spade a spade. You and I on this show have always not minced words. That unfortunately can often be a buzzword for, hey, we were hoping to recapitalize, but the market is not ripe for that. So we've got to raise money to, sort of get a credit facility and keep growing our EBITDA. And, it's a shame. It's not every case, but that unfortunately, when you see that, sometimes it means, hey, we would have preferred to have gone to market, but it's just not in the cards this year. So we're doing the credit facility thing.
I'm glad you said it. It's we've seen that a couple of times in recent months.
If you can't go to market and get maximum strategy, the good backup option is to raise your credit facility. So I think it's very smart of those I'm not criticizing. It's very smart of those organizations to do that given the market conditions, but I'm just reflecting that's just not terrific. We would have preferred to see a wonderful announcement that they went to market at a record multiple and everybody is happy. Instead, we're seeing an announcement that they raised a credit facility, which means, hey, it's like we grabbed a Snickers bar, better get
it's an interim solution to get them to the outcome that all the stakeholders desire. Right. We got a credit facility continue to grow. We're going to wait out the markets. And ultimately, when multiples return to reasonable levels, we grow our EBITDA through same store sales. We'll be able to capitalize on the market when it's there. That's the way I would read that.
Yeah.
So DSOs are not foolish. They're run by really, really smart people. And the folks that run the business development teams are pretty brilliant in most cases. And they recognize that they can't keep paying what they've been paying for from a cash basis for deals. So they've gotten creative with structure. And I wanted to talk a little bit about structure because what you see here is something we've seen pretty dramatically from 23 to 24 and could see more of in 25. When we started looking at transactions in 2022, the average allocation for enterprise value is about 80% cash and 20% equity. That was the starting point from which we would negotiate and have a conversation. This year, it's been a lot closer to 75% cash and 25% equity. And if trends continue, it's very likely we're going to be at 60% cash and 40% equity as a starting point for a conversation around how to allocate $8 million worth of value. And when you run the math, the delta there is about $1.2 million decrease in cash at close that's in allocated equity, right? And there's risk in that equity. And Brian and I could tell you a couple groups we would give our left arm to invest in other groups we would invest our enemy's money in, Is that fair, Brian? I mean, they're just not all created.
Yeah, I mean, you've said a number of different things, but, we've been 60-40 for a while. I mean, this is interesting looking at these statistics, and Kevin, you do all size deals over there. And some of the deals you do are maybe a little too small for me, or other of my team members might do them, but they're a little smaller for me and I'm not studying them. But, most of the deals that I'm involved in that have some substance have been 60-40, for a long time on the larger deals. I thought 8 million was large enough to be 60-40, but maybe you're able, at least historically, to get away with 75-25 or something like that. But, for a long time, most of at least the deals of substance that I find myself working on have been 60-40. So, that in principle doesn't bother me, but the issue is you got to pick the right partner, right? I think what you're taking away is a bit of a margin of error. Now, anybody that's ever listened to me talk ever one time has heard me say you got to pick the right partner. You always got to pick the right partner. But I will say this, if somebody's willing to give you 80-20 and you pick the wrong partner, you only got 20% caught up in a rollover. So it's not going to be terribly devastating. I mean, still, that's your money. I'd like to see you get a maximum return, but it's not going to be, particularly devastating versus if you've got 60-40, which I've been seeing for a long time, and you pick the wrong partner and you've got 40% tied up in the wrong partner and it becomes a disaster and doesn't return, well, then the deal almost becomes not worthwhile.
Yeah, I agree. It's the partner is critically important, especially with allocations like this. If we see multiples go down, the only thing that's changed here, Brian, is the exit multiple going from 8 to 7 on $1 million of EBITDA. I mean, this is where we are likely heading or at, depending on the quality of your business.
Well, the banks won't let it. I mean, some of this stuff here, like this 8 to 7, which I agree with, I'll tell you what that is. The banks are getting savvy. It's taken the banks a little bit of time to figure out, what their credit facilities were being used for. What I mean is they always knew, like in the last 5 years, hey, we're going to give you this credit facility and you're going to go ahead and expand and buy offices. Like they knew that. But what they never really did before this current, call it a mini recession we're in or whatever, is the banks never really did a deep dive into, hey, how exactly are you spending my money? I know you're buying offices, but what multiples are you paying? And what are you doing here? And I've even been engaged by some banks very recently, like last year, where they said, Brian, we don't understand these markets. Explain these transactions to us and tell us exactly how everything goes down. And I've met with certain banking executives on an education mission. And, they've paid me for my time to sit there and educate them on the anatomies of these deals and how they go down. And as a result of, the last year, the banks really starting to research this, they're going to some organizations and they're saying, hey, I understand you used to pay an 8 for this size practice. You can't pay more than a 7 anymore. Or, we're not going to let you go higher than 6 for this. So the banks are actually putting these type of restraints on the market. I've never seen that in 29 years, but the banks are starting to really get sort of savvy as to these transactions. And they're starting to a certain degree, Kevin, to micromanage them in certain organizations.
Yeah, we've heard from some buyers that said, look, we're not going to bid over this multiple for anything on a go-forward basis, period. We're not going to do it. And when you peel back the layers, it's the lender driving those decisions, just as you're saying.
Yeah, that's what it is. I mean, most DSOs, all things equal, they would love to be able to bid on a deal if it's the right deal, but the bank is really constraining them.
I want to make sure we spend time on the special DSO space. You've already said in the last 5 years, you've seen more consolidation there than you ever expected to see. It has been a rapid rise that you've actually played a really big part of. So I'd love for you to walk us through how we got to where we are today and where you think we're going.
Yeah, no, we'll do it quick because I guess we got not a ton of time, but a little bit of time. It used to be all about consolidating GPs. And I remember at my conference, you've been coming to my conference for many years and participating. It wasn't that long ago, even 5 or 6 years ago, that people would say, yeah, specialty is going to get a lower multiple. I don't know if I would do a specialty DSO. The GPs are where it's at. I mean, they were saying that 5 or 6 years ago. Now the specialty DSO DSOs really are commanding most of the premiums in the marketplace. So it's fascinating the way that has turned it around. And, the characteristics are, things that are really recession and pandemic proof. I mean, really, like I'm talking about like government proof. Like when the government said you can't go to the dentist, they said except for emergencies. And anybody that ever had a root canal, boy, that's an emergency. Or you need some type of oral surgery, that's an emergency. So they were able, at least, I remember I talked to Pat Haynes about this from Thurston Group, who was the sponsor for U.S. Oral Surgery and U.S. Endo, and I talked to him about this on stage at my conference. He was saying during COVID, the heart of COVID, he had a conversation with me where he was like, yeah, the oral surgery is down about 10-13%. We're hanging in there okay. We're doing great. There was just a tiny amount of patients that were canceling their appointments because they were worried about the pandemic, but the overwhelming majority, because oral surgery and endodontics is pretty much essential emergency type stuff, nobody canceled their appointment. So the people started to figure this out, investors, and they said it's general recession proof, it's pandemic proof in general, it's government proof, where the government says, you can't go except for emergencies. This is emergency stuff. So between endodontics and oral surgery, it's absolutely, it's probably one of the highest performing segments of the business right now, or the industry right now.
I mean, we've seen some great businesses kind of travel in the wake and created in the wake of these founding fathers in all these specialties, in orthodontic, in endo, in oral surgery. And now there seems to be a new one coming out of the woodwork. Every week. We are talking to new private equity groups, or private equity groups that have done dental in the past that are now looking to create a new oral surgery group or have their first platform.
And I think ortho is terrific too, but the one thing why I put ortho slightly below endo and U.S. oral surgery is if there's ever another COVID, and hopefully we've learned a lesson, Kevin, and we won't be just wholesale shutting down the country or something, but if, God forbid, something like that ever happens again and people decide like we're actually doing a shutdown again, unfortunately, orthodontics like GP is vulnerable to that type of shutdown, whereas oral surgery and endo was not, because they were more emergency procedures. And it's like, we're either going to the ER or we're going to our oral surgeon. And even everybody, the ADA, the governments, when they defined essential treatment, oral surgery and endodontics were within the definition of essential, where unfortunately orthodontics like GP, if there's ever like a flat out shutdown, it's vulnerable to that. But otherwise, ortho is terrific. I think if you're going to continue to see huge growth in orthodontics, I just think it's just a little more vulnerable than oral surgery and endodontics.
Ortho was really interesting during COVID because we were all at home. People wanted to take care of their bodies and their faces and their smiles. And ortho got a really nice lift coming out of COVID, but we're really starting to see starts decline slightly, depending on the market, depending on where you are. Folks now saying, look, I got my teeth straightened up. At least on the adult side, adult ortho really got a nice lift coming out of COVID.
No, it absolutely did, because people were wearing masks. People that were worried about, the like, oh, I won't look good with braces or with an aligner in, now had to wear a mask every day. So they said, nobody can see that I got, braces in here. So totally cool. Let me put my mask on and I'll get it. So there were really unique things like that happened. And I think that in part led to ortho growth, but ortho is just a very strong segment of the specialty DSO market. So I think it's still going to do well. There's direct-to-consumer ortho platforms out there that rely on telehealth, and there's just a lot of potential in what you can do with orthodontics.
Well, it's going to be fun to watch this continue. The business models are changing. It is, and they're growing so rapidly. Brian, it has been a pleasure as always to talk with you and spend time with you. Where will we see you? How can people get a hold of you if they have additional questions?
Yeah, sir. You can always go to DykemadSO.com, DYKEMA DSO.com, and all my information's on there: phone, cell phone, email. You can get a hold of me. So now it's so big. If you just Google Brian Kaleo Dykema, my contact information, comes up super easy. If people, need to get a hold of me, I guess we should have done a barcode. You guys are way ahead of us technology. Yeah, we don't got a barcode.
Everybody knows you. They know how to get a hold of you.
But you can, look, Google me. You can get a hold of me really easy if you have any questions. And those that submitted questions here, like I said, we'll answer them in 24 hours, because this was such a lively discussion. I don't think we had a chance to go through all the questions that we have. But other than that, I think I'm going to be at several conferences for the rest of the year. The DSO Leadership Summit, I think, is in Austin. I'm going to be there. There's an ADSO event in December I'm going to be at. So a lot of conferences, still before the end of the year that I'm going to be at. And I'm looking forward to seeing how the rest of this year sort of shapes up.
Yeah, me too. It's always exciting. End of year is always exciting. Getting those deals closed right before the end of the calendar year, and I know we'll be on the phone with you and your attorneys a lot as we approach the kickoff of 2024. Thank you to everyone who submitted questions. I'm getting the look from the producer that we have to go and give you back your evening, but we will be back in touch with you and answer your questions within 24 hours. Thank you all for joining us. We'll keep you abreast of everything that's happening inside of the M&A markets. And thank you for your time this evening.